Hello and welcome to another episode of Nothing Ventured with me, Shah. Today in the studio with me, I have Francois Mazoudier. Francois is the founder of Fundraising Bootcamp, a very non-MBA in-person system that's helped over 300 startups close close to $1 billion in funding during the worst market in years by ditching theater and executing process. Francois has lived the whole startup roller coaster. He's built 5 tech companies, took one from zero to IPO, crashed another into the wall, and kept going. He co-founded Real Networks, EMEA team on the way to NASDAQ, helped shape early IP video at Picturetel or Polycom, ran marketing at The Cloud, and co-founded Speed Ventures, one of Europe's first serious accelerators backed by Soros and Schroders, now Permira. In today's episode, we talk about how 6% of pitches end up in a deal.
Little stat, 6% of pitches end up in a deal. 6.
Why you should stop reading and believing everything you see on the web, trust in the data instead.
Number one, what is it that people should stop doing is reading and believing what they see on the web.
How 250,000 pitches are recycling the old Sequoia pitch deck template. Are they actually succeeding?
Please do not download the Sequoia pitch deck template.
And why there are only 2 things that are important at the earliest stage. What's the market size and can you execute?
What's the opportunity? What's the market size? That's why they say, show me something that could become very big, although you haven't started yet, and show me a team that can execute.
How you need to be able to talk to me about your business without talking about your product or your tech.
Introduce yourself. You're not allowed to talk about your product or technology.
And whether European founders are too humble, especially when pitching to US investors.
This North Europe humility is just playing against us all the time.
Let's get straight into it. Hi, whilst I've got you there for a second, I thought I'd reintroduce myself. My name's Arish. I am the host of Nothing Ventured, the podcast where I talk to the people behind the stories that make the venture ecosystem go round. I'm also the founder of Emerge One, a consultancy that provides fractional CFO support to venture-backed tech startups from seed to Series B and beyond. If you enjoy the podcast, do rate and subscribe wherever you listen. And if there's anything you'd like to talk to me about, do reach out to me on LinkedIn or Twitter. I'm always up for a natter. Right, let's get straight into it. François, really happy to have you in the studio with me today. Thank you so much for taking the time. I know you're sort of jet setting around and about Europe. Really wonderful to have you here.
Likewise. Thanks for having me again. I think it's, for those who don't know us, we've been discussing this for 4 years now.
I think pre-pandemic probably, and, although I didn't launch until after, so maybe not quite.
So I'm really glad that we finally made it happen.
Yeah, no, it's all that effort in WhatsApp, I think, has finally paid off. Listen, we talked a little bit in the quickfire about what you do at Fundraising Bootcamp, but given the kind of plethora of experience that you've had, I want to take this in a couple of directions, right? So first off, I want to kind of expose really what is the truth around fundraising right now. So you've put over 300 founders through a live, high pressure process. I'd love to understand, where do they waste kind of 80% of their time, and what do you do to make them stop doing on day one? What is it that they need to stop thinking about rather than start thinking about? And then give me the kind of before after on email sequencing. How do you manufacture scarcity without lying? And what are the 3 tells from your perspective that a founder is fundable and scalable? And the 3 tells that they should probably step aside and maybe revisit down the track. There's a lot. Yeah.
So we're going to try and take that in order. So number one, what is it that people should stop doing?
Yeah.
Is reading and believing what they see on the web.
Okay.
Little stat.
Damn it.
We're big on hard data at the bootcamp. Little stat, 6% of pitches end up in a deal. 6.
Yeah.
So 94% of what founders do today, which is a repeat of what everybody else tells them to do, does not work. So first thing, follow the hard data. Don't follow the opinions.
Yep.
Plenty of opinion in there, tens of millions now, all wanting to be LinkedIn influencers and regurgitating the same thing, repurposed by the same AI machines. Please stop reading this. They don't work. We would know if it worked.
Yep.
So number one, look at the hard data and follow that instead.
Yep.
So the first thing that we do is to show you the kind of non-friendly, non-trendy data sets. Which sectors, the world's saying if it's not AI, it's not backable. What a lot of rubbish. So we show you which sectors are actually up You may remember that actually fintech, just before the AI craze, fintech was the big thing here in the UK, and actually health tech beat it several years, but nobody explains the kind of the hard data-based opinions, especially their triggering. It's much more interesting and, gets more reactions. So first thing, stop reading and believing what you see. If it's not hard data, ignore it. Number two, learn about venture capital. If you want to raise from VC or learn about angels, most founders don't understand what 2 and 20 means, or a hurdle rate, or what the difference is with an evergreen, and so therefore they pitch
what's a CVC versus like a VC versus
precisely
versus a syndicate, right?
Yeah. And so they come. It's almost like they go pitching to a wall. They have zero idea. They're completely blind to the person they're talking to. And guess what? Investors also want to talk about their business. They love their business, and they can explain an awful lot and give you a huge amount of hints before you have to go and pitch. So ignore this pre-formatted pitch deck, having to somehow sell and perform. I laugh every time I see these VCs to say, it's a performance, you have to put on a show. No, give me the double PhD in nuclear science, even if he's a bit weird socially. I'll take knowledge over performance skills. Yeah. It's a bit like acting the same in reverse. Hey, get an actor to become a double PhD in neuroscience. Maybe not. Stay in your lane. So that's number two. Number two is learn the business of investing so that you understand and you can truly be a peer in the relationship.
And aligned, with not only what the investor is looking for, but also how they think and how they understand your numbers in your business, right?
Because that drive assessment.
Yeah.
Once you understand how you're going to be assessed, you're going to realize that your product pitch and technology and specifications and comparison with another product has and attracts very little interest.
Yeah.
But show me an amazing market that hasn't been served the way that you can or do or are doing already, and suddenly you've piqued my curiosity. Number three, again, ignore what you see. Please do not download the Sequoia pitch deck template and do what everybody else does. Investors are looking for the odd one, the outlier, the different one, the better, fastest, the number one. So why would you use exactly the same template? It's been used over 250,000 times now. Jesus. 250,000 pitches are based on that. And you think you're going to come out and stand out from the crowd. So please don't do, again, all of these shortcuts and quick 1, 2, 3 to fundraising. Just ignore them. Number four, what we do, which I think is the most important, is perfect match only. Hard data, again, not a personal opinion. DocSend reports 2023, the average, not the best, certainly not the worst. The average is 77 perfect matched investors you outreach to, gives you 40 meetings, which give you 3 term sheets, therefore reasonable, fair deals. So I think it's gone worse since 2023. So we started at 100 to 120 perfect match. It's not because it says SaaS that it's a good match. You're going to have to figure out and research. We have technology tools to do that and automate it. What the actual what the actual investor has written, blogged, tweeted, so that you can say, well, if you do this and you say that and you believe in this, that's what we do. Let's chat.
It's a bit like Shipshape VC, I think, doing exactly that. If you know Daniel Sorko. Yeah.
The idea is once you have a perfect match, everybody thinks that nobody answers emails. It's not true. But stop the 99% of spam crap that I get as an investor. That's frustrating as hell. As soon as I find someone who starts their email by saying, this is where we seem to be a perfect match, obviously the door is open. Even cold emails work really well. We have a 62% reply rate. The average is less than 2.
I thought you were going to say open rate, but I mean 60% reply rate is amazing.
Well, because obviously I'm in the business of investing in that stage, this sector, and these kind of tracks.
This has piqued my interest. It fits within my thesis. It fits within my mandate. I better open it up. If that's my job as a VC is to invest in businesses within this mandate, this fits, I better have a look at it, right?
It's kind of obvious. Yeah. So we don't have
it. But no, you say obvious, but it isn't, right? Like otherwise you wouldn't have a business.
It's a bunch of small processes which have been perfected with time. Remember, it's not because I'm smart, because I've made every mistake in the book. I've been there for 30 years now, and I think I've made every possible one. So we'll teach you the nasty side of which term sheet clauses you should not have, how to negotiate them out, how to address and how to find perfect match investors, how to get introduced to those investors from people who you've never met. I know it sounds crazy, but they are very good reasons why you should connect with people and say, please introduce me because, and then explain this.
I think that's how we met, probably. But yeah.
Probably.
Actually, no, we met at Founders Factory. That's a story for another time.
Correct. Founders Factory. That's true. So basically, the process is ignore what everybody tells you, because the web is full of repeated terrible, which leads to a 94% failure rate. Do something that actually works. Ask the people who have fundraised efficiently. They're all going to tell you, oh my God, what a waste. I have wasted so much time. I started with my board told me 25 in our investor targets is fine, 25. My board had a personal friend or 2 or 3. They said, I'll make the introduction. Completely unmatched investors. You waste time all the time. We see this across hundreds and hundreds of companies. Biggest one and biggest gripe. It takes a lot of time, so preparation is key, because all the documents will be squeezed and asked right at the end of the process when somebody else wants to join the round. If you don't have these documents ready, you can't let them in without extending the round, which is a terrible mistake to make. You have one process, one calendar, you stick to it.
This is the unsexy side of venture, right? Like in the sense that, to your point, right, it's a process, and not only is a process around how you approach it, it's also what you have in the background. I talk a lot about, obviously, making sure your finance hygiene is place, like your numbers are accurate, are representative of what you're doing. Your forecast is sensible, isn't like too out there, but equally kind of you can back up the assumptions that you made, that you have a data room, right? That an investor can just go to and literally checkbox, right? They're incorporated in the right jurisdiction. They have the right insurance in place. They got contracts with their staff, et cetera, et cetera, et cetera. Okay, that's made my job 100% easier, or 100 times easier than if they didn't have that in place, right? So I think it sounds incredible to have you sat in front of me, having helped over 300 founders raise close to $1 billion, say, go back to basics, that's why you're not raising. It feels incredible to me today that conversation is even one that needs to be had. Equally, the thing that concerns me a little bit on the other side of the table is investors now moving more and more towards sort of AI type matching of deal flow with their thesis, and potentially trying to look at founder traits using AI and, so on and so forth.
It's cool.
It worries me because, to your point, an outlier is an outlier, and often it is a human that's going to find that outlier, because it isn't going to be around the data. It's going to be a feeling in the room, something that they said, something nuanced in the way they did something, which is not going to be identifiable by a data set. That's the whole point, right?
Bingo. Which is why I understand Horowitz says VC might be one of the last bastion of human only. Yes, use the tools and filter out, but it's not to find them, it's to filter out the junk so that you're left with less meetings to have with less interested. But the same is going to apply. Do I trust you? Are you competent? Do you have good character? And 3, do you have a process? Or am I the only one at this table? In which case, I'll play the clock every day and I'll win every single time.
Yeah, because I got 3,000 decks coming across my table. I will find one, right? Because I can only invest. And this is the other thing I think founders often don't recognize. VCs aren't investing in every business. Obviously, they're not investing in every business that comes across the table, but they're investing in an incredibly small number. Most VCs may do maximum 20 deals in a year, and that would be a pretty full-on shot. So going back, if you were looking at the other side of the table almost, what are the 3 things that, when you're talking to the founders that come through your cohorts, what are the 3 things that show you that actually this founder's likely going to be able to get funded and likely going to be able to scale? And what are the 3 kind of signs that maybe they should revisit?
So that thing is pretty standard. Have you built a product in your garage with your mate from school, and then you think that the world is a better place with it, and you haven't talked to a single customer or users? So product market fit remains number 1. Yep. First rung of the ladder.
Is there a market? Do people want to pay for
using it? I don't even care whether they're paying for it. But at least, do you have users? Do you have a product that works? Do users enjoy using it? And then we'll figure out monetization later. But if you don't have that, you still have a tinker project from the garage with your mates. And there's lots of
Many of those,
who
yeah.
think that they are, going to take on HubSpot and Meta and the others. So number one, do you have a market that actually fits your proposition? Do you have a real solution? Paul Graham, do something small and do something that people actually want to use. Number two, I think it's the most critical, is start learning. If you don't have the knowledge of the other side of the table, you're pitching a wall. And don't be surprised if the wall has no interest in you, because you have no interest in them. There's a human thing, right? So question, answer. This is how humans build trust.
So almost like growth mindset. Are you willing to learn and
Correct.
and be able to grow from where you are
And,
today?
and number three, have a clear process. Otherwise, you will deviate. People will drag you out, and you will run out of time, run out of options, because you've been hoping. The number of times I hear these hope and prayers all the time. You haven't followed your process. You haven't followed diligently your list, and therefore you're out of options. And out of options, out of time is exactly the place where you don't want to be as a founder. So build a process, follow it religiously. It's just like a sales process. You're going to lose some, you're going to win some. As long as you have enough in your funnel, you will close the deal. And remarkably, I don't want to throw a number, I don't know, but I would say it's in the 75 to 90% of funding rounds are without a set process before. It's incredible.
That would not surprise me at all.
I talked to another person. He introduced me to somebody else. I have a vague list on some, on some CRM. It's terribly run, and therefore people run out of time.
Yeah, and actually, there's a couple of things within that I would echo. Obviously, the product and the market side is critical, right? Like, these are the things that I think often get overlooked. The only caveat to that is I think anything that is like very, very R&D intensive, where you are, it's your PhDs in nuclear, like they're not going to have a product day one, but they are almost certainly going to be fundable, because in 5 years time they could be developing something that could be absolutely revolutionary, right?
There are ways for this, by the way, and we do a lot of deep tech, like the space thing. And they are all extremely complicated. You don't have to have this kind of view of having how many users and all this at all. But what you need to demonstrate is that you understand where the market is moving. I love the contrarian view. The market's going this way,
go the other.
We're going to go the other, because that's where there's less competition. Two, people have not realized yet. I always use this one example, but there's plenty of others. When Spotify went to fundraise, Apple just announced $1 billion of revenue. The music game is finished. We are Apple. We have all 5
from
music
iTunes.
labels, 99 cents a track. This is how it's going to be done. They had to go a long way against the grain to say, hey, you don't have 12 million tracks storage and $12 million to spend on music, so you're going to have to be a new way.
Which was the same with Uber and with Airbnb. Those were market creators, right? I mean, the other thing that I think strikes me is, I think about this all the time. Often founders need to shift their mindset, right? Like, they obviously look at their business as their baby, and rightly so, right? Like, they're pouring a huge amount of time and effort and energy into it. But one of the things that really gets my goat is when a founder says, I'm giving away 15% equity, I'm giving away 10% equity, or whatever it is. Because I'm like, no, you're selling your equity. Like, literally, there is a transaction happening. The buyer is buying a share of your business, and you are selling a stake in that business that has value. The value is not defined, because the value is a negotiation. The value is whatever the market is willing to pay for that stake in your business. And I think if founders kind of can get themselves out of the mindset that actually they're doing an investor a favor by offering a piece of their business, they would do a lot better, because they would look at it much more transactionally. I always tell founders not to remove emotion from their belief in their business, but to remove emotion from the process, essentially, right? Yes, be emotional about what you're doing and why you're solving it and how big the market is and how great your team is and all that sort of stuff. But remove the emotion from, this VC turned me down, therefore they must be crap, or that VC offered us terms which are awful. Yes, that you are going to get, in any negotiation, terms that are unpalatable. That's what a negotiation is. You give up some stuff and you win others, right? So I think removing that emotion for me, I think is a critical part of this whole process. And obviously, we do a lot of stuff as CFOs. That's where we come in, where the kind of cold, mechanical, kind of robotic, no, this is how you do it without the emotion. And actually talking about kind of that side of things, if I had to get you to pick between numbers and narrative, which would it be, right? So if we were to delete either the story or the metrics from a pitch deck, from a round, which one do you save and why? And you can't obviously say both. And what does a fundable story look like when the numbers are messy, or vice versa, when the story is like really compelling? Really not compelling, but your unit economics, your traction is all going in the right direction.
So super early stage, you have nothing. So nobody has anything. You don't have revenue, traction, contracts, guaranteed of anything. So therefore, what do people focus on? What's the opportunity? What's the market size? That's why they say, show me something that could become very big, although you haven't started yet, and show me a team that can execute. If you look again at hard data, same thing. DocSend produces fantastic report every year, and they track what people look at when they're on your PDF. And that's across 150,000 companies plus, I think. And basically, when you listen to a lot of investors, they talk about the vision, the mission, and going to Mars. And when they spend the most time really inspecting, it's the financials. So can this thing really make me can this become a $100 million revenue business? And number two, the team. Can this team, is it just a bunch of ideas? And people have found an amazing idea, but there's zero execution firepower behind it? Or do they have a team that can actually take it from here to there? And if it's 10x, I can sell. So show me the 0 to 10. Don't show me the 0 to 100. Most likely a late stage investor will come behind us. And as you know, most angels, which is where you're at when you're super early stage, is not going to follow you until an IPO or an exit, most likely. When it comes to later stage, then switch that completely over, and you're going to find that investors no longer need the vision, the mission, because they know if the market has bought and used your product for a couple of years, 3 years now, and they're spending more and more with you, I know the product works. I know there's a market, so therefore the rest is kind of irrelevant. Mark Andreessen, A16Z, again, has this amazing contrarian saying, frankly, I don't care that much. Show me a huge market and show me a adoption rate, conversion rate. I don't care about your team. I don't care about your product. I don't care about your KPIs, because the rest sells itself. So you have this very hard switch, most likely at Series A, which is why it's so difficult for most founders to nail their Series A, because you go from a vision, mission, I have nothing, trust me and like me. You should focus on building a team that actually trusts each other. Again, question, answer, question, answer, question, answer, to a completely KPI-driven. A lot of people don't have the revenue yet. One of the modules that we have, what do you do if you don't have the revenue traction that's going from 0 to 10 million in 2 weeks? It seems that the numbers are getting more and more ridiculous. You start showing KPIs, because once you track, you know that revenue is the result of having your engine room, your 4 pistons functioning. Nothing functions when you start. So show me, we were at this in CAC, now we've halved it. We were at 2 people, now we're at 5. These people used to handle 300 support issues, now we're at 100. Improvement across your pistons in the engine means that although you're not there yet, most likely that company is going to go in the right directions. So track KPIs super early on. That's how you can make a numbers-based pitch instead of having follow me to the moon. It hasn't worked out, but maybe it's going to work after you put cash in my company. Not a good strategy.
No, and this is, I think, the thing that, again, founders don't understand, right? They think about traction only in terms of financial traction. And exactly to your point, like I was thinking as you were talking, it could be about how regularly you're shipping, again, to your point, how many support calls, how many bugs solved, users. It could even be something as simple rather as return rate in terms of, how often users are coming back to the product. Obviously things like monthly average or daily average users, like all of those things are proof of traction without necessarily revenue. Revenue is the result, right? And this is why we always tell founders, revenue is not the KPI. Revenue is never a KPI. It is an output from the KPIs, right? So if your KPIs are traveling in the right direction, revenue, whether you are currently revenue generating or not, revenue will be the output of those KPIs going in the right direction. Because if you can capture, and this is, again, that whole thing about Steve Blank, get out of the room, talk to customers. If you can capture 1,000 customers who love your product, who absolutely adore using it, and you ask them to pay a tenner, well, you're already at 100,000 ARR, right? Like that's the way to think about traction versus revenue. And I think it's incredibly it is an incredibly difficult shift for a lot of founders, because a lot of founders have never run a business before. They aren't repeat founders or repeat entrepreneurs. So to your point, they've gone from selling the vision to like, shit, I got a business that I've got to sell here now. How do I do that? But you can still do that using the numbers. You've just got to figure out the narrative that sits behind the numbers, right?
Yeah, I've got something which is normally very, the room goes silent and it's controversial. Why is there so much hatred between pure play venture capital and corporate venture capital? We understand the end game is different, and the goals and the payments and the whole thing, this structure is different. But as a founder, I always ask that question: would you prefer to raise 10 million, hire a team, try out 15 acquisition channels, the cost, the managing, the mistakes, and then fire, rehire those who don't perform, get sales involved, and then get them to convert and eventually get to that revenue? Or would you prefer to give your shares away, 10, 20, 30, 50% of the company, but only if Microsoft gives you 10,000 fully paying customers? Which one is the quickest route?
No, Microsoft, obviously, right?
Obviously, right?
It's like
it's highly controversial, but it just realized that people have this perception again, which has been
no. But I'll tell you why it's controversial. Sorry, I'll tell you why it's why founders look at it problematically. Right? Is it caps upside, because immediately you take that money from Microsoft or whatever, whoever it is, you are essentially signal. The market is taking that as a signal that, okay, at some point Microsoft is going to acquire, or someone of that ilk, right? And if they're in this early and they own 30% of the cap table already, am I going to get my $1 billion exit? Probably not.
OpenAI is, I think, a good example of that.
Yeah, but actually, my counter argument to that is, to the founders is, so what? Like, and you and I talked about this, right? Like, if you sold 30% and you exit for 100 or 200 million, you're going to be pretty happy. If you essentially dilute yourself down to 2% over multiple funding rounds and exit for $1 billion, is it going to be worth that pain? And the likelihood of the result is obviously also much, much smaller. So I completely buy into that sort of thing. And I think also, again, this comes back to what we were talking about earlier about understanding your investor. I wrote something just the other day and got a lot of flack from various people about it.
It's a good sign.
Yeah. But it's always the same guy who's giving me flack. But no, so it was, I split it down. Like, founders don't understand. You got your tier one VCs, or what I would call actually your more traditional VCs, whether they're tier one or not. You have your corporate venture, you have your SEI, SEIS funds, you have your angels, obviously you have your syndicates, etc. All of these have very different incentives layered in. Therefore, as a founder, you should understand what those incentives are and see whether they align with yours. And then you can make that decision. Like, if you don't want to exit to Microsoft, don't take Microsoft's money. Like that, at that level.
Yep, that's what we do. That's exactly what we do on day one. It's remarkable how little knowledge exists. Yeah. And I understand, typically amazing engineer, scientific founders will come out of the gate with an amazing product or invention or half-baked product. They haven't had time to look at, the other side of the wall. But if you don't understand the other side and their own, it's kind of obvious. It's kind of any relationship, it's like a sales process. It's like a doctor. It's like any relationship with humans. You're going to have to understand what drives the other side first, and then be able to match. Otherwise, you're just not going to be a peer. And that conversation and subordination goes very, very quickly the wrong way.
So actually, one question I did have for you, sort of slightly aligned to all of this, is, you're working with founders, as you said, pre-seed all the way through to B. If I'm a founder who's already raised a seed, a Series A, what am I missing? Have I just not been driving the process the right way? What is it that you think that those founders at those later stages are learning to do better? Is it still the same thing around process, etc.? Is it often the case that they kind of got lucky because they had the vision, because they had the cool tech or the PhD or whatever it was, and they're able to kind of get by for those first 2-3 rounds? I guess I'm asking, why do they come to you having already been through a couple of successful fundraisers?
So I think that fundraising is a skill that every entrepreneur should have. and should acquire. It's a bit like, running a team, understanding a budget, knowing how to build a product, and knowing how to be good with people so you can attract the very best people.
Yeah.
Job of a CEO is to set the vision, the direction of travel, and then find the resources to attract the very best people who will then build it with you, for you. It's not about you doing everything. And so what I find everywhere is you have those who realize after 2 rounds, maybe I really didn't get the best deal, and you realize after the fact.
Yeah.
I've got this funny picture that shows, most founders know someone like this who just raised, and instead of jumping up in the air, the picture of someone who's hollowed, exhausted, and said, I've been gamed. I realize I've been played.
But I was so desperate to land the cash.
I ran out of time, ran out of options, didn't have enough negotiation power. I took what I could, but it's actually so much below what I could have had I prepared better. So you have those who have learned by mistake, and then you have those who realize we have companies that had raised 20 million that came to us. We have Series A companies that come back again and again to say, I really want to focus on this because it's a very practical, technical stuff. So I don't give you theories. I'm not writing a book. I'm not trying to be a Techstars or another accelerator. We do just one thing, get you funded. And what they've realized is that they are always missing a beat in their process. And if you miss one beat, or if you reopen the calendar, all the cards are out again. And so a lot of them come and say, I did okay so far. I realized I got played. But now that I'm going to raise 15 million, these little percentage points and difference and control rights and the board rights can mean that I'm going to be either in control of my destiny or I'm going to be under somebody's thumb and I have no idea how to structure this. So it's one of those things. I think it's a skill for life that you should acquire. I would have no business, but I genuinely believe it should be taught at MBA or University of Entrepreneurship. And I've checked MIT, Yale, Harvard, ESAD, INSEAD, all of them will teach you how to be an investor and teach you finance.
But not how to be a founder.
Not how to be a founder and fundraise on good terms and in good times and control the process.
Well, that's where you have people like Brad Feld, right, coming out with venture deals, right? Like, I mean, that if people haven't read Venture Deals, if you're a founder and you haven't read it, like, fucking, what are you doing? Go out and read it. Like, please, honestly, you will learn so much more about control in economic terms and on a term sheet and be able to navigate that, that much better if you don't have time to do, a course or not get, although obviously go and do Francois's Bootcamp, like 100%.
Set the direction, raise well, so you can attract the best people. Those are the companies that, hit it big.
Yeah.
Those who raise badly, poorly, because they just don't know and they realize much later, usually the other ones who don't have the capital they need to attract the very best, therefore they become second, third,
or the founders get pushed out by the boards or whatever it is, right?
And then it's a miserable 10 years of your life. Miserable.
Yeah.
Again, I've made that mistake. So it's not because I'm smart. I've suffered it.
You had the scars, like you know what it's like. So look, I wanted to move on to something that is very dear to my heart, which is Euro founders and hard mode, right? So you helped build Speed Ventures, you rode Real Networks for an IPO, you ran go-to-market at the cloud. What are the very European mistakes you still see? And one of the interesting things actually that, as you were saying, when they go out and they're trying to raise the 15 million, I got off the phone with a founder, just raised their Series B, $55 million, raised from the US. I think Peter Thiel's on the cap table. Whereas in the UK and Europe, 55 is probably a Series C, if not later, right? Like 15, 20 million is probably a Series B.
Series B.
Yeah. But I guess the question is, what are the mistakes that you still see? Tone, pace, modesty over engineering, and how do you coach them out of that without them losing the strengths of discipline, resourcefulness, and that kind of mindset around growth?
We start on day one, minute one, introduce yourself. You're not allowed to talk about your product or technology. And then you wait.
Wow.
And you'd be surprised how a Series A that has raised 2, 3, 4 rounds gets...
So one second, is that introduce themselves as an individual or their business
company.
As a company? Right.
That's the first thing. So most European founders are going to possibly themselves live by the values of their company and associate themselves way too much with the business.
Yeah.
I'm investing in a business. Obviously, I'm investing in the people building the business, but I'm investing in a business. So talk to me what the business is trying to get to. How is it going to be dominant? What's the moonshot? How big is the moon if you hit it? What are the 5 obstacles along the way? What are the 5 accelerators that you might find along the way? If you can't explain this in these terms, you're not ready to have a walk with me and a chat. and talk to me like a normal human person. And if you can't do that, then you're not going to be able to address late-stage funding. Late-stage funding will obviously be heavily over-indexed on numbers, traction, acceleration, improvement of all the KPIs as we discussed. But that's stage 2. Stage 1 is going to be, do I believe that this market opportunity is there, that you're capable, your team by now is fully formed? Tell me about a moonshot. So we call this the financial narrative. You can start with a narrative, but nobody gives a crap about where you come from and your grandma telling you, oh, little girl, you're going to become a really good entrepreneur one day. Skip all this and explain what the business is, where it fits, where it sits in its market, why it's starting to look like something really promising, which now needs a big injection of capital for go second gear. Second gear can be expansion into the US or another country, or come to London if you're not from London, etc. So that's the number 1. Number 2, what I see the most is this division of north-south in Europe. So the Nordics have got this thing called Jentelaw, maybe you know it, which is part of their culture. You're not allowed to brag. But yet when you show them, investors are not looking for something which is quite good at a decent growth rate, with a nice team. That is
you need
unbackable.
some arrogance.
You're going to have, if there's one time in your life you have to be American, it's the time when you go fundraising. You're going to have to be the first, the fastest growing, very strong KPIs. You're going to have to dominate somewhat. And this is where American investors really struggle when they meet some of our companies here. However amazing they are, this North Europe humility is just playing against us all the time. By default, they're half. Americans are typically over-egging their stories, so they cut them in half. They do this to our European businesses, and they look average businesses. So it's very difficult. So there's an element of translation and rewriting the story and representing the business in the eye of an investor. Number 2 is, I say, if you were the investor, why invest now? Again, no product. Just tell me about the business. Why is it a good time to invest now instead of a little bit later? A little bit later, the valuation might be a little bit higher. I invest at B and C. I can wait.
Yeah.
What is it? Where is it going to take me? Something that founders typically do very badly is to say, I'm going to raise 10, 15, 50. Once you've spent it, where will you be at? So
what are the milestones you're going to get to?
You're worth roughly that much on a multiple of 10. Where are you going to be, and is it worth at least 3 to 5 times my money? Otherwise, game over. I don't care what you do. I don't care what the product is. I don't care about your team. If I can't make minimum 5x my money, because the risk, my 50 million check is a significant check.
It's the cost of capital, right? Which again, founders don't necessarily understand. They assume that this cash is just sitting there waiting to be deployed. Okay, and there is a fair amount of dry powder out there, right? But ultimately, investors, VCs, have an obligation to return capital to their LPs. And in a world where you don't have zero risk, right, which we did have for like 10 years when interest rates were close to zero, that was fine. But now money costs something. And if you're not returning something to those investors, to their investors, then it's just not worthwhile.
Yeah. So humility, terrible thing. South Europe is behind typically because they don't have access to many support mechanisms in organizations. There's a few exceptions, but that's why you see a massive catch-up from non-UK, France, Germany, or SOCOM. Everybody talks about, and it upsets me a little bit, everybody measures how much money was poured into a company or a sector, and they say, well, Sweden is the best company for startups because on a per capita basis, everybody has raised more money, i.e. everybody's more indebted. It would be like, judging a country based on the level of debt that everybody has in that country. I find it remarkably stupid. Yeah. Whereas you have outstanding talent. Little footnote, which I always like to add. Remember that the biggest IPO for a European business is a company out of Romania.
Yep.
Check this out. And therefore, everybody passed because Romania. And so I think there's a whole bunch of European traits that don't get picked up because of these geographic, nationalistic, and lazy traits that some investors have. You have the very top of the food chain. They track everything. They're super professional. Your chances of getting a check is, close to a 99 or 99% no, but they're super efficient. And these are the ones that you start your process with. But typically what you're going to see is as soon as you go down the pyramid of amazing investors to average investors and poor investors, oh my God, the pyramid is very wide at the bottom. And this is where you enter terrible territory. And sometimes you really have to think, should I load myself up with some kind of extra complicated debt, venture capital, with someone who's really going to be dragging, not supporting. And I find for B or C investors, most founders make the right decision and say, I'm going to bootstrap this because this is just not an investor that will elevate anything, but will just drag us.
And do you think those traits can they be coached out of founders easily? Or is it, because some of these are somewhat inherent, right? Like the humility point is something I've said again and again, right? And it comes across as lack of ambition, whereas actually what it is a little bit like we don't like in the UK saying how great our business is. Someone asked me how my business, we're okay. We're doing okay. This year was all right. It wasn't bad.
So this is where hard data plays its thing. Once I always remember we have loads of Balkan-based companies, and we realize, that your competitor has smoked 60 million and has less revenue than you. You've raised 1, and you're now European leader. So hard numbers, avoid all the noise, the marketing. Look at the hard numbers, follow the data. Usually you reset saying, actually, I'm performing well above average. It's not because you raise more capital that you have a better business, right?
It's because your business is better.
There's this view that is being presented all the time. Amazing, they've raised 100 million. Yeah. How many companies have you heard that had raised 100 million that went nowhere? And compared to these my heroes are the guys who've raised very little. Yeah. And I mean very little, 1 round, 2 rounds max. Because I believe as a person now, you're much better off, and I know it's very contrarian, but you're much better off having an amazing 10 years with the team that you love and you've picked and you've grown with slowly and sell for an average transaction value. Europe, last year, 2024, 50 million exit. And, if you have 80% of that, it's 40 million. You do that twice every 10 years. There's no other industry that gives you the quality of life, the excitement, and serious cash in your pocket. No founder needs to have $1 billion in cash, and to get there, the amount of complexity and the chances statistically for you to get there are extremely small. So I understand what the whole world of investment wants and truly needs to have those big ass exits. Founders, just do the maths. Yeah. Do the maths. Yeah. I love MailChimp. I love DHH. David Hansen from 37 Signals, and now Hey, and there's loads of them. If you don't raise VC, typically you don't appear in any newspapers, magazine, blogs, conferences. So look at the hard data. Go and talk to them. They're amazing. Yeah. These are the real heroes of tech, in my view. I couldn't agree more. I have a couple of kind of tail end questions. You may have answered this one already with your last point, but if there was one thing you had a contrarian conviction about, whether that's from any area of life, whether that's work, politics, social, or at home, what would that be? I think the biggest contrarian one is bigger is not better for founders. It is absolutely needed for venture capital. So choose the source of capital. As a founder, look at the guys who keep it small, and my God, you'll see how much happier. It's okay to have 80 or 100 million in cash over your 20 years. You're still going to have all the material things that you seek, but the amount of control and the lack of complexity and the lack of feeling bad because you're not growing at the rate that your investors want and need will change your life. Yep. So look at the hard data. Bigger is not better for founders. That's my contrarian point. You and I have talked about this, and I'm very firmly in that camp. And finally, so we can get to know the real you, what is something that moves you emotionally? Oh, good question. I'd say 2 things. Personally, it's piano.
Beautiful.
I think piano has always, and it remains at the top of my to-do list. I'm terrible at it, but as soon as I have time, i.e. never.
Of course.
Yeah. I'm going to learn the piano. I have the keyboard. I have the 2 lessons. I've had everything, but I'm not making time for it. But this moves me every time. Yeah. The second one moving me, and I think that's more on the professional side. I don't know if you know Rich Rawls. They have a fantastic podcast about how you go from elastic and flexible intelligence in your early years, where you produce without, working too hard, and you produce document intelligence. You come up with an idea. That's your best years of being productive. And then after 50, you switch over to what's called a crystallized intelligence, where you start picking up patterns and say, no, don't do this because I've seen this. Yeah. And history repeats itself all the time in technology as well. Yeah. This laughable thing is to say, no, this time it's different. It's my 3rd tech crisis, and this time it's different. Yeah, I tell you it's not. Yeah. And so what makes me emotional is when I see those companies coming in, learn and have this eureka moment. And a lot of them have, if you go to our our blog, you'll see how they have a mindset shift about how much of a partnership investment and investors are. And when they click and certainly take off and have amazing partnerships with real investors that add value, and they come back to us and say it's changed the trajectory of the company, I feel like a bit of a roosting or whatever. I feel like a bit of a roost and the mama. It makes me really happy now. It was difficult in the beginning, losing the ego to say it's not for me to do, it's for me to guide and endorse. But it's super satisfactory to see people who stay close to us and how we've helped them elevate.
I think that's absolutely lovely. I think because piano aside, which I learned for about 10 years of my life and then stopped. But I think there is something massively satisfying about just being, even if you're on the sidelines, being able to help someone get through, that period, whether that's the fundraise for us, whether that's getting through, a difficult audit or a difficult board meeting or whatever it might be. But just being able to say, I helped. I didn't help because I'm earning something out of it or whatever, but it actually is just gratifying to see that not only did I help, but also that they took on my advice, used it well, and ended up with the result that they were looking for. So no, I think that's absolutely wonderful. François, has been, as always, an absolute pleasure having you here on the podcast. For the audience, where can they find you online? You're on LinkedIn, Twitter. Where's the best place to find you on the internet?
The best thing is going to go either our website, boringly, fundraising-bootcamp.com.
Yep.
You have a blog, you have access to hundreds and hundreds of CEOs. Don't listen to me. Go see the founders. There's plenty in your category, your stage, your sector. Go and click their name, ask any one of them. Otherwise, you can find me on LinkedIn at my name, Francois Mazoudier.
Amazing. Well, we'll put links in the show notes. Thank you so much for joining me. It's been an absolute blast.
Honored. Fantastic. We did it. Thank you.
Finally.
Thanks so much for having me.
Amazing.